Good afternoon and welcome to this webinar at the European Freight Market Outlook. And of course, good morning for our American friends that are listening in as well. Today is all about Europe. We're going to talk about the scenarios and strategic implications, which is much as saying as like we're going to review our previous crystal ball, and we're going to look into the crystal ball for what's going to come in the next 6 months. That also brings me to the next slide. It's our legal notice, which means this is a crystal ball. So if you want to make it specific to your situation, please talk to our team. They will make it specific and go through the details. Before I introduce the speakers, a brief introduction on our webinar platform. On the right side of the screen, there are actually 3 tabs, chat, docs, and Q&A. A chat is where we will, and here you see a message from Rimke, we will post messages. Docs is where you can download the presentation that we are presenting today, and Q&A, that's where you can leave your questions, and we will try to answer as many of those at the end of the session. All right, let me introduce the speakers of today. I'm here with 2 of my favorite colleagues in Europe, Milena and Guillaume. Milena heads our air freight product for Europe, and Guillaume heads our ocean freight product. So they will be opening up their crystal balls for you today and talk you through the scenarios that we think are likely to happen. Let's go to the agenda. Okay. We will be starting with a quick review. How off were we? How right were we with our past predictions? We like to do that because we hold ourselves accountable there for our previous predictions. Then we're going to talk a little bit about the trade wars and all the uncertainties that are ahead, specifically talking about the geopolitical conflicts that are happening and influencing global trade. And then we're trying to make it specific for you on what are the implications on ocean and air freight. Let me get my colleagues on stage, and Guillaume, Milena, let's look back. How off were we with our past predictions?
Good afternoon, everyone. Yes, thanks, Sanne, for the introduction. So looking first on one of the 2 predictions, we spoke a lot last time about Red Sea and North American tariff expectations. So I'm going to talk through a bit the Red Sea. So during our last webinar, so back in February, there were just a ceasefire that was happening a few weeks before between Hamas and Israel. So there were a lot of questions about Red Sea reopening, not reopening. So at the time, we built 3 scenarios. We built one scenario about like Red Sea remain closed. Second one, we talked about a soft opening. And a third one was about like reopening of the Red Sea that comes with a bandwagon effect. That means things get worse and congestion goes up before it gets better. Our preferred scenario at that time was the scenario 3, the opening and the bandwagon effect. We were clearly wrong with that for the simple reason that, as everyone knows quickly, the Houthi ceasefire was never confirmed following the actions in February. The strikes went on the Red Sea, which caused several casualties still over the summer, and also the US strike on Yemen and on the Houthis went on as well. So Red Sea is still not a safe passage, it's still closed. But this said, the conclusion of the 3 scenarios that we had together last time in February was that the odds today, so in February, were pointing at a downturning market in 2025 due to the risk of strong overcapacity, but there was still a non-negligible risk of seeing upward volatility happening. And if we look back on the main trade lane that was impacted by the Red Sea diversion, Far East to Europe, this is what happened the last year, right? So we were in a high market at the beginning of the year, but declining one. And we are now reaching a pretty low level in October. But in the meantime, we had some fairly high peaks during summer. So I think it's all about scenario planning, right? Like most of the scenario you spoke about turned to be wrong, but they help you finding patterns and likely and unlikely events. And that's what we did last time, and we'll try to do it again today. Milena, on the Far East season.
Before Milena starts, so basically what you're saying is like we were right on the mega trend. we were wrong on the trigger for it, right? So it still
Absolutely.
is a downturning market, but if the Red Sea would have opened, it would have been a much stronger downturn. Milena,
Absolutely. So,
Yeah.
let's talk about air because a lot happened there in the last 6 months.
Yeah, well, exactly. So we also, in our webinar in February, we talked a lot about what could have happened with tariffs. And amongst other things, we predicted these three things that are basically the volume on China-US lane reduction because of the de minimis cancellation, consumers that would not stop buying e-commerce products, and e-commerce production that got diversified, so moved from China elsewhere. And we actually got 2.5 of them right, because the de minimis cancellation did cause a very, very big drop in volume. So US made drop by 50%. Volume year on year compared to last year. The other one that we kind of got right was the fact that the consumers would not stop buying the e-commerce products. They really didn't. It's just that for a period of time, the US clients actually received those orders from the US fulfillment centers, and e-commerce invested pretty much in publicity and in expanding into other markets such as Europe, LATAM, and Middle East. The one that we got half right was that the minimis cancellation and the import into US of e-commerce products would be simply solved by moving the production somewhere else. We could not predict back then that the Trump administration would actually cancel the de minimis from every single country on the planet. So it's not only from China or from other Asian origins, but every single country that wants to ship something with a low value needs to go through a proper customs clearance when it arrives in the US. So I know that today in the webinar we have many shippers, and you all know what it means to put your product on the market. So actually, what mainly caused this drop in volumes from China to US and on e-commerce in general into US is not so much the tariff increase and the increase of the product cost, but actually placing those products on the market to be properly customs cleared. So this means that basically the markets need to be the products need to be accepted by the U.S. Customs. It needs to be compliant with the laws and regulations in the U.S. The whole process of preparing the customs clearance is actually a very lengthy and a very detailed process. So there were some e-commerce players that were already ready for this, so they continued shipping, even though a little bit less. And so for other e-commerce players, this is still work in progress. So it is true that actually, as we speak, the volumes on e-commerce from China to the US are slowly increasing. And basically, the products are more and more properly imported into the US. So this is what we got wrong and right in Feb.
What is, though, an interesting fact, of course, is that it's not duty-free anymore as it used to be, right? So the business case for many shippers has changed, where de minimis is no longer attractive because they pay air freight on that. So we see a lot of customers, let's say, domesticating their supply chain, which means local fulfillment in the US. But for some shippers, it is still attractive to have overseas fulfillment and then work through the postal system. But it means that you have to pay duties. So there's no duty avoidance or duty mitigation scheme anymore for e-commerce.
all right. So this is another slide that we had back in February. So at that time, we were listing the top uncertainties at the time, right? So I think we can confidently say that all of them are not really uncertainties, but they just became the norm that we have to work with today, right? So Red Sea remain closed, and we don't expect it to open in the next few months. Trade war and geopolitical tension, I don't think I need to make a drawing to anyone. The odds are that they will still be there next year. And for the economic outlook, well, if the three before remain unstable, saw the economic outlook, right? So they have put here just some last number that the United Nations, the Commission for Trade and Development, published for its maritime expectation, trade ones. So they reviewed their forecast down for 2025 and 2026. Now they are between 1-2%, and from 27 onward, around 2 to 3% annually. That basically means a compound growth of like 15% from 25 to 30. So it's less than last publication earlier this year. And the main reason why they adjusted those downward are, as they state, geopolitical uncertainty and trade disruption. So those are, again, in the middle of like the news. And what we want to do today in the next slide is to basically reflect on those events that happened this year already, the trade war and the global conflicts, understand what are the learnings that we had this year and what recommendation we can formulate from those on the coming months. So we can start with the trade war.
All right, let me take that over. I think the trade war is, of course, there's a lot of news about it. I think it's one of the most, televised and covered activities in global trade for a long period of time. So most of the details are known and you might actually know, but I want to run quickly through where we are today, right? We've already talked about end of de minimis, which is the e-commerce duty-free clearance into the US. That initially was valid for China. Now it is valid for all countries since August. So there's no parcel going into the US without paying duties. That's very clear. Reciprocal tariffs are now on all different countries. So the percentages are highly varying, and if you want to know specifically what it means for your product, I highly recommend you to go to tariffs.flagsport.com. It gives the latest and greatest on everything that you need to know about tariffs into the US. It also includes all kind of exclusion codes. It's a very comprehensive overview. We parsed something around 300 pages of legislation into it that was just released over the last couple of months. So it's very comprehensive. Number 3 is the proliferation of what they call Section 232 investigations, which means there are sectoral investigations. You've seen the latest one that was announced was on furniture and specifically upholstered furniture, where there is additional tariffs being charged on that sector of furniture. We've seen it before with steel and aluminum and copper, and we're expecting much more of that to come. We've also seen on the pharmaceuticals, etc. So, a lot of this is actually being debated right now on the U.S. Supreme Court. The reciprocals are being fought in the U.S. Supreme Court. What we should anticipate is that whatever comes out of the U.S. Supreme Court, tariffs are here to stay. The shape and form might change. It might be sectoral tariffs. It might be all kind of other tariffs that are made up if IEEPA or reciprocal doesn't work, but tariffs are here to stay. And I think what the last piece is, there's still a lot of ongoing negotiations. A lot of countries have not basically figured out what is the right way to collaborate with the current administration in the US, and there are no clear trade agreements yet being made. So also that will cause a lot of disruption or uncertainty in the next coming months, because countries might fall out of favor. Countries might not get to an agreement and all of a sudden being slapped on 50%. So it's really important if you're making sourcing decisions that you're taking this into account, that the situation or the context might shift very quickly. So I would highly recommend you to work with one of our trade advisors, trade advisory team, or with your customs broker to help you out what the options are there. Let's go to the next slide. Guillaume, back to you.
Yes, thank you, Sana. Yeah, I'm going to zoom in a bit on the impact of Liberation Day that happened exactly 6 months ago, the 2nd of April, and see how it impacted the whole ocean trade, right? So we saw, if you look at the big picture, so that's the first graph on the left, you see the year-over-year TU annual growth. And if you look only at that graph, it's from the intelligence, it's not that bad, right? So the first few months in April, May, June, we see that the growth was around 3, 4, 5%, so slightly above the GDP growth. So it's not that bad for trade growth, but there are very different forces at play. And if you zoom in on the second graph that you see here, there is a serious decoupling between US-bound trade and rest of the world, right? So if you look at the US on one hand, it's been a bit of a roller coaster, right? So first the tariff came, the carrier and some forwarders reported 30 to 50% drop of booking from China to the US right after. Then came a tariff pause. We had a massive cargo rush because all the shippers were trying to get their cargo out into the US before the pause stops. But quickly the peak was reached, rates turned down again. We saw that we barely had a summer peak on Trans-Pacific the last months. And now the outlook is pretty depressed, right? So we had also, I put a number from the National Retail Federation in the US that they recently published the reviewed import TU forecast for the end of the year, and they expect those to be down minus 18% year over year in Q4, right? So that's pretty depressing. If you see now this new graph that's showing up, that's the rest of the world, right? That's different import region. So you see North America down on the months that are displayed between April and July. But the growth is pretty strong on some other region, right? You see Africa very strong, LATAM pretty strong, Europe imports pretty steady as well. So what we see is like the Chinese exports that were going to the US have been partly redirected to other regions, to Europe, Africa, Southeast Asia, LATAM. And we've had the confirmation of that also with Chinese customs number. So the last one that were published over the summer indicated that China's sales to Europe was up 9-10% year over year in July, August. And at the same time, they contracted to the US by 6 and 11% respectively in July and August. Right, so there is some reshuffling taking place in global trade flows, but the trade goes on. So the recommendation there is like for any scenario planning, as Sana, you mentioned, we should expect those trade war, and in particular the US action to go on over the next few years and under the Trump administration. There will be more constraint to do business with the US, and the environment will change fast, right? So that means fast adaptation is needed, in particular with everything that's customs related, of course. There will also be more trade flow being redirected away from China, not to the US, but then the rest of the world, which brings the question, like to me, at least from a European point of view, all the trades, all the flows that go to the EU, how will the European Commission respond to those? Because that means increased competition from Chinese goods, right? So there is the question of seeing this Commission implementing as well potentially new tariff and anti-dumping regulation to protect the industry, or try to take the spot of leaders of the free trade world away from the US. So that's something that's going to be observed in the next few months and probably next year. I think we can go on the next slide. So we spoke about tariff impact. There is another tool that the US are using at the moment. That's the USTR 301 regulation. So first, what is that? So that stands for US Trade Act Section 301. It's a section from like 1974, and it basically grants the US the right to retaliate in case, like against foreign countries that violate trade agreements or that are considered as engaging in practices that cause harm to US commerce. So this is a common tool that the US are using. Not only Trump administration, Biden administration was using it as well, often directed against China over the last few years. But if you look at the maritime industry, today there is a new regulation that comes in place October 14th, which imposes tax on Chinese built and or Chinese owned operated vessels. Sorry. So what you can see on the graph, like this table that came from Alpha Liner, you see the different potential fees for next year, according to the regulation, and according, like, looking at today's capacity deployment on TP and TA mostly. That's like going to the US, and you see there's different impact. The Gemini Alliance seems to have the less exposure, and of course the Chinese carriers, COSCO, including OOCL vessels, are the one that are the hardest hit, because more than half of the total fees could be directed against them. It's important to mention, though, that today all the carriers that made a public announced that no surcharge will be implemented following this new fee that come live in October. That's also interesting to check that we had a look last few days on the capacity being deployed to the US, mostly on Trans-Pacific and Trans westbound. Those are the two big trade touching the US. And if you look at the Chinese built or operated vessel share relatively to the total capacity, it was around 26% back in Q1. It is, as we enter Q4, around 18%, right? So there is indeed a few of those vessels that were shifted away from the US and probably redirected on other trade, but the shift is not massive either. So in conclusion, if you look that there's no new surcharge and there's not a drastic change of capacity around, you can see that those sanctions don't have yet a material impact on the shippers to the US. This said, it's important to note that those sanctions are incremental. That means they will go up in the coming 3 years, right? So that doesn't mean because there is no fee today, carriers will not decide otherwise tomorrow. My feeling is if next year a fee comes, even if the carriers suffer different impacts, they may come with comparable surcharge levels just for the sake of market competitiveness, right? Because if one outprice themselves, then they lose out. I think the last comment I want to make on that is that we've seen over the last few days that China is laying ground for retaliation measures. So you know that with the US tariff, China has often used a tit-for-tat approach to US sanctions. That means they just respond the same. We can suspect they will do the same again here. So we should expect US vessels and shipping lines to be targeted in return in the coming weeks and months. And we'll also have to keep an eye on that ahead.
Yeah.
All right, a lot of talking on my side, and I think Milena, maybe you want to take it up further.
Yeah, exactly, because then I would like to talk a little bit about the global air freight demand and supply, but actually what you just described is one of those situations where air freight becomes the strategic tool to use, because of course when vessels cannot go, or when there is a rapid change in tariffs or any kind of regulation, then that's how and when the shippers actually turn more and more to air freight, and that's what we call front loading, actually. So you want to be a destination before something like this happens, right? So if we go to the next slide.
Before you go there, I do think what's also one of the impacts here is that you'll see that quite a few of the larger vessels, which, the ultra large vessels are all built in China, that will come to the market will be pointed at the European ports, right? So it will mean a mix shift to larger vessels for the European ports, and as a result, some additional capacity being deployed on the Far East westbound.
Yes, and also because there's not many ports in the world that can take 20,000 TEU vessel. So there's always a cascading. I mean, TP will be mostly 15,000 TEU vessel, but that might cascade down indeed on Far East, and potentially currently Far East capacity going down to some other trades in Africa and Latam. So yeah, there's definitely a high likelihood that there is some cascading effect on how the vessels are deployed.
Good. So if we go on global air freight demand situation, basically we are still seeing a like slow and steady progress. So this year the growth is being measured on around plus 3%. So that's pretty far away from the 11 or 12% growth that we saw last year. So it did definitely slow down, but it is still there. The numbers are not negative. And the growth of this year is primarily being fueled by two factors, which is e-commerce, which is continuing to rise, just going in different directions, which I'm going to cover a little bit later. And the expansion that is still ongoing of sea air corridors between the Middle East and Europe, which are a direct consequence of the Suez Canal closure. So what drove the growth this year a little bit is also the front loading that I mentioned a little bit earlier, because in the beginning of this year we saw a lot of that, and the front loading was actually very lane specific. It was pretty much only on China to US, but also some other Asian origins to US. And this growth that was rapid was followed by more or less the same, in the same way, rapid lane-specific decline. So let's say until April, and also a little bit later, the volumes went up on air freight, but then especially after July, the volumes on this lane are much lower. If we look at the rates are from the beginning of the year quite steady, still a big mix of lanes because it is not everything on the same level, but there was no big peak or big dip in rates, except again on the Trans-Pacific. There are two largest trade lanes that are basically we are looking at the most and that are creating the biggest part of what you see on the graph that is representing the demand and supply, and that is the China to US and China to Europe. So these two biggest lanes in the world, they're going in exact opposite directions. So while Trans-Pacific is reducing rapidly, China to Europe is actually growing. So August, which is the last month that we have certain data of, it was a very strong month. Again, very lane specific, different by region, but still we saw some growth. And on the supply side, for the first time after 2019, this year we see some kind of balance between the demand and supply. Still, there is a lot of struggling with manufacturing aircrafts because the pieces are still not being produced rapidly enough, and the supply chain is not as smooth as we would expect. So this year the growth in capacity was around 3 to 4%, but next year we do not expect a different picture. So it's probably going to be 3 to 5% mostly. That is because not a big part of the ordered aircrafts are being delivered to the market. And what is interesting to note, the aircrafts that are confirmed to be delivered into the market are mostly going to the integrators and to the larger Middle Eastern carriers. So this is also a good indication of where the demand is going in the next year or years, actually.
I think one of the things that we probably need to say here is that this is a high-level picture, but it doesn't mean that certain port pairs or trade lanes aren't congested, right? Vietnam, it's very hard to get any things out of Vietnam. You will get it out, but it's expensive, right? There's a lot more demand than there is supply originating Ho Chi Minh and Hanoi. So you have to be very careful with, let's say, putting the macro view on the whole market. But the macro view is true, but there are port pairs where the opposite is also true. So you have to go very specific there, specifically on the air freight side.
Yeah, it's very different. Also, inside the same trade lane. So Trans-Pacific is different country to country, but also Far East westbound is different country to country. Because, for instance, while it is relatively okay to find space into Amsterdam and Frankfurt, it becomes more and more difficult to find space into London and Manchester. And this is also inside the Far East westbound lane. Yeah. So if we go to the next slide, we are actually touching another topic now, which is geopolitical tensions that are stretching our supply chains. So this is becoming actually more and more important because everything that happens in the world has a big consequence on the supply chain. Doesn't matter if it's ocean or air. These kind of things can disrupt heavily. Like it's sufficient to look at what happened with the Suez Canal closure and the Russia and Ukraine conflict that is keeping the airspace closed above Russia for most of the airlines. And these are the things that we need to look at and we need to navigate through.
Yes, and I think the word stretching works well here because I want to speak a bit about, again, the Red Sea and hence the Cape of Good Hope passage, right? So that there's definitely a stretch on all the services that touch Asia and Europe with longer distance there. So as said in the introduction, there is no sign in sight for safe passage in the Red Sea. So Cape of Good Hope routing is the norm, means longer distance, more risk of delays, and also more capacity being absorbed, right? There is also something structural with the blank sailings, right? We've seen that blank sailings are constant now through the year. So of course, there are peak period like Golden Week or Chinese New Year, but they also happen even in normal times because some carriers on some specific service just don't have enough vessel to operate weekly port calls via Cape of Good Hope, right? So you always see some blank sailing coming. And if you look at that, the delays and the irregular flows of ships that touch different ports, that builds up congestions. And congestion is probably like the biggest pain in Europe, at least was probably the biggest pain in Europe the last few months. It's also a vicious cycle because congestion builds up, and usually the higher the yard occupation, the less productive the cranes. And so the higher the congestion gets, et cetera, et cetera. So it's difficult. We are starting to track that also at Flexport, looking at the average dwell time of the main vessel that touch different European ports. So we have that for different ports. I put Rotterdam in the pictures. So you see that that's not really resorbing, right? So like 2 days dwell time is quite high in Rotterdam. And it's not getting better at the moment. We also have different carriers that publish number. So HMM, for instance, have some number around yard occupancy. They still consider that yard occupancy is above the 80%, which is seen as like a critical level for Antwerp, for Rotterdam, RWG, for Hamburg CTA, for Southampton. And we are getting close to this level also with the main Italian ports, Genoa and La Spezia. So the situation is quite tight here. And because there is such a tension in the market, low idle fleet, high congestion, carriers will have limited ability to absorb brutal new changes. And hence, that's definitely a risk to see the market turning upside down again quickly later on. So if you show on the next graph, the SCFI, so the Shanghai Containerized Freight Index that goes to North Europe or the Med, you see those waves, right? We just came since the Red Sea in a very volatile market. And it will remain so, I think, as long as there's such a tension build up. So there is, as we discussed earlier, a lot of signs pointing in the direction of a pretty fragile market next year. Weak demand on some trade, in particular to the US, high capacity added. But to me, there is still a pretty high chance that volatility remains ups and down. And I don't think it's going to be a flat and quiet year ahead. So it's going to be important to take that into account as you negotiate for your annual tender for those of you that do so in the coming months. But we'll come back on that in the conclusion and the recommendations.
Yeah, and there are some things also to mention on air freight. So I touched a little bit the Russia and Ukraine keeping the airspace above Russia closed. So this is forcing the longer routes between Asia and Europe for most carriers, of course. And this is not only raising costs, but it also reduces available capacity because when an aircraft lands, it needs routine checks, maintenance. The crew has their mandatory rest periods before flights, between flights, and this makes it not so easy to have those quick routings and more frequent flights over these areas. If we talk about the airspace closure in the Middle East as well, we had a couple of them this year. They were, of course, caused by conflict. So every time something would happen, the airspace would close. And while this didn't last for months, but it was maybe a week, weeks, or days, it makes it still manageable, so doesn't create big backlogs and things like that. But it can become a problem if the airspace also above Middle East becomes closer for longer time. Amongst other geopolitics events that could affect air freight, we are looking closely into the Taiwan Strait. This is very important for commodities like semiconductors. These are very fast-moving goods, and if something would happen in this part of the world, there could be a high demand for emergency freight. So this would then create the need for more capacity going into Taiwan. Still on the same side, South China Sea disputes. This presents a threat for navigation freedom. So if major shipping lanes get disrupted, that would impact air freight as well. Same things for sanctions on certain ocean carriers. If they limit the market access, they could complicate the global cargo flows. And then something that had happened recently, and it's a little bit closer to home, was the closure of the Poland and Belarus border from 12th to 24th of September. So Poland shut down the border, and why we're talking about this, it's not because it was only closed for civilians and trucks, but this border specifically presents a major rail corridor into Europe, and it is estimated to be worth around 400,000 TEUs per year. So if we convert the 400,000 TEUs conservatively into chargeable weight on air freight, we would talk about 24,000 tons yearly. So now, not all this volume can go on air freight because of commodity, because of size restrictions. But due to the transit time, because rail, if I'm not mistaken, has a transit time of around 18 days. So due to the transit time requests, it could not go on ocean, but it would have to turn to air freight. And Far East westbound market, just like we mentioned a little bit earlier, is a bit fragile at the moment. It's a bit tight. So if even one part of this volume converts into air freight, we would have capacity issues. So now the border is open again. There is a backlog, but it is manageable. But it can happen again. And it is important for all of us in Europe to look at this, because this will affect every lane in Europe if it happens again, and if it creates the backlog that we think it might create.
Yeah, and it's interesting because everyone is always talking about the big crises, right? And if we have an issue in this Taiwan Strait, we might be all dead. So that's a whole different a level of conflict. But these like smaller conflicts like that close the border between Poland and Belarus can have real impact on supply chains.
So yes, I wanted to add this one because we talk a lot about e-commerce, and we often tend to talk about e-commerce as e-commerce and air freight. But what we should do, actually, we need to put them together, because one of the biggest stories in air cargo is this transformative impact that e-commerce has on the air cargo. So this big demand for fast deliveries created a need for massive changes and investments in airport infrastructures across Europe, Middle East, also around the world. But we are concentrating on some of the most important ones, as I said earlier, close to home. I couldn't put everything on the slide, and I cannot talk about every single airport that is actually investing in the infrastructures to accommodate this kind of volume. But there are some of them that are really important. So Liège Airport is in Belgium. It is a relatively small airport compared to Frankfurt, for instance. But this airport has been serving commodities like perishables and fast-moving consumer goods already for more than a decade, very, very successfully. So today, what is happening, e-commerce is using this airport to go into Western Europe, and they are expanding, they are investing heavily into infrastructures in order to accommodate everything that is coming their way. Another one is Budapest, where today we have more than 50 freighters flying into every single week. It became a very important hub for Eastern Europe and for one part of Southern Europe as well for e-commerce. There has been a 51% year-over-year increase in air freight in Budapest only, mainly, and I don't want to say only, but mainly driven by e-commerce. Madrid, same thing, very important hub for e-commerce. And actually Middle Eastern airports like Dubai and Doha are investing billions into their infrastructures because they want to be heavily involved into in e-commerce. So while I'm saying all this, it is true that e-commerce is driving the need for infrastructures, but it also means that every single other commodity or every single other vertical market can actually benefit from this. Because if we get more capacity into these airports, and as well, there is a lot going on in the UK and in Glasgow airport as well. It means that more and more capacity is going to go there, and it means that these are going to be open corridors for all of us, for all kinds of more or less all kinds of commodities. So we always think about e-commerce as, of course, in Q4, it is taking away a lot of capacity, but there are also opportunities behind all this. And it also underscores that this is not just a segment of the air cargo market, but it is actively reshaping basically the physical infrastructure and the future of air freight. So it is here to stay, and most likely in the coming years, we are going to see more of it.
All right, so let's jump to the section of recommendations. Guillaume, what do you recommend?
Yes, I have a very last comment to make with a very loaded slide. But before jumping on the recommendation, there's one thing I wanted to point out, because we spoke a lot about demand outlook crisis, but we didn't speak about carrier potential actions, right? And I think it would be underestimating the impact they can have on the market, not to mention the possible action they can take. So what I put here in the slide is a few pictures and graph that shows threats for carriers today, right? So on the bottom one, the dark slide with the bars is like the order book from different carriers toward 2029, which now represents 30% of the total global fleets. So it's quite big if you compare when we said earlier in the introduction, the UNCTAD number, were mentioning a 15% maritime trade growth potential over 2030. So overcapacity is looming. We have the right graph, the total empty TUs reposition. So that means the global trade imbalance are worsening, right? Flows of goods between Asia and Europe keeps being more imbalanced. That means for every full container loaded that a carrier has to move, they have to account for the cost of repositioning the container 40% of the time, right? So that's something extremely heavy for shipping lines and that the shippers don't usually see. And all of that puts pressure on their financials, right? So the financial of the carrier the last few years, it's been doing the roller coasters, like the freight price, right? It's been very high during COVID. It dropped very low just before the Red Sea, and it spiked again during the Red Sea crisis. But we are following again a downward slope at the moment. I think carriers will not stay without taking action. So we know that they have, at least I think they've been better at managing capacity dynamically over the last few years. They reposition vessels faster. They blank faster as well when they need it. So they will definitely try to take actions. And very concretely, we see that today as well. If you look at Trans-Pacific, they were first July announced in September. That didn't really stick because of a weak demand, but they are trying out. And we are hearing the first announcement of GRI, so general rate increase, on Far East westbound as well for mid-October. And what we see usually is like the first round have often mild effects, but they aim at stabilizing the market price before pushing different round of rate increase along with blank selling. So the rate go up again as we get closer to Chinese New Year and as we are entering the annual tender season and negotiation. So I think we should expect carriers to also be quite active on that side in the coming months, and hence the conclusion and the recommendation that we can formulate. So on the next slide, so we have three big recommendations, and Milena and I will go through and Sana as well on those three. So first is diversification. For those who follow the webinar regularly, you won't be surprised. We usually formulate that recommendation. It's true in normal times. It becomes even more important in volatile times, right? And that's what we are talking about today. It's really important to de-risk, and for that you have different options. You can ask your forwarder to present you a multiple carrier strategy, or you can de-risk with validities to have like different contract terms, short term, long terms, index. So there is different options for that. Your forwarder can help you diversifying your carrier strategy and your contract strategy for that. Milena, do you have anything to add on the diversification part?
Yeah, more or less same goes for air freight. Like besides the rates, only what you can diversify as well is either maybe go to a nearby airport if it's possible, of course, with the customs clearance and everything, or maybe take a look at the sea air options, because that's a very valid alternative. And yeah, from there we can go to maybe even larger diversifying options, such as nearshoring or changing where your production is at, but that's of course that requests a little bit of planning ahead. So just like you said, Guillaume, for air freight it is valid as well. Origin airport, destination airport. Try to see where you can deliver from, and stay up to date with everything that is happening in the market.
All right, and we can go to the next one then, is transparency and stability. So on the stability part, yes, of course, we've shown you the graph with the price fluctuation. So it's very dynamic, up and down. Many shippers would like to get more stability. So it's going to be important to take that into account. And stability doesn't mean the cheapest all the time. But there is also a certain point where stability is just not possible, right? And in that case, that's where you need to ask your partners and your forwarders, your carriers, transparency on when your rates will have to move up or down. You can ask your partners to gamble for you, but you need partners that can depict a fair picture of how the market is and what are the best solutions for you, right? I'm going to give an example that comes up a lot in negotiation. It comes every year during the bid season that's ahead of us. Is around peak season surcharge, right? So it's a great topic because many would like to get peak season surcharge to be inclusive. And then from there, you have two answers to that. Some that will say, no, sorry, it's not possible. And they will gamble for you. But the reality is when the market really surge, even if you don't get a peak season, then you get an allocation right sizing, right? And you don't ship on your contracted volume. We've seen that some carriers, some forwarders sometimes. So it's important to have a fair discussion with your partner to ask, if the peak season arrives, if my rates has to change, if my allocation has to change, what are the criteria we need to look at together, right? And I mentioned again the indexation part. This is now very frequent in industry. You have index you can look at. You can also look at your performance over the year to understand when your allocation needs to move. how you can influence your weekly allocation to optimize it most of the time. So I think transparency is going to be very important for your negotiation in the next month.
Yeah, and for air freight, transparency is actually crucial. And for air freight, the only way actually to get to some kind of stability is by having a transparent view on your supply chain. So I think at all times, you will need to have a clear picture of what is happening on the market, what kind of rate will actually get your cargo to fly, what will be the validity. Not every moment of the year is the same to go maybe for a long-term validity or for a spot rate or something like that. So from the moment you are talking about rates with your freight forwarder, talk also about the transit time and what is actually realistic to achieve. And into all this, you don't only have the airline, where do they stop and how long before the next flight, but it's also what is happening at the destination airport. Is there a strike? Because lately we have had many. Is there anything else happening at the destination airport? Are the ground handlers moving? So all these kind of things are very important to be communicated on time so that you can actually tell your own clients when are they going to receive their orders. And with air freight, we know every half day counts. And if something is going on and you don't know it, it could become a problem.
Great. And then for the last recommendation, it's of course anything around technology, right? You need to stay in control of your destiny, which means having full end-to-end visibility, not only on your operational flow, but also on your compliance flow, which means tariffs, and on your financial flow. Obviously, we offer a lot of tools there. So if you're not working with us, definitely inquire. If you're working with us and don't get everything out of the application, you should talk to your account manager, because then we should definitely make sure that you set up the right reports, that you use our Insights Builder, which is a chat GPT based question and answer in the application. I want to do one more shameless plug before we go to the Q&A, and that is the next slide. In 2 weeks, on October 14th, we will do a live broadcast from Flexport Forward, which is our US client conference. We'll bring this also to Europe in the next couple of months with all our new products that we will be launching. There's a lot that will be AI native. So it's going to be an exciting webcast hosted by Ryan. And there's a link that Rimke will post that you can register on and follow us live there. Then let's jump to the Q&A. There are a couple of questions, and I want to go to a question that is about the impact of the China-built vessels on US port calls, and whether we have a tool or a way to analyze the impact on the shipping profile. Guillaume, is that something that you want to answer, or you want me to take that?
Yeah, so I was mentioning indeed that there's no impact as we stated, right? So carriers will pay the fee apparently, but on the shipper side, there's no fee announced by the carriers at the moment, so there's no real impact on that. Would you have anything to add on that, Sana, or you're on the same point of view?
No, so as a result, and Guillaume already told us that the China-built ships will be reduced on the Trans-Pacific trade, and likely also on the transatlantic trade, but those are typically a little bit more smaller and older ships, which are more Korea and Japan built. So there will be some changes, but it's typically happening through vessel rotation. So they rotate a China-built ship out and rotate in another ship, and that has no impact on the strings.
Yeah, and then maybe you can tag. I think there's 2 other questions that are ocean related, so I can go through them. There's one that's around the market direction. So someone commented that the ACFI is headed to a pre-Red Sea crisis. particularly on Asia, North Europe. And the question is, how aggressive do we think the carriers will be heading in the contract season? And will they put a lot of effort in propping the market up? So yeah, on the ECF, I think there's different positions, whether it's moving to the US or to Europe. Into the US, the market has already come back to pre-Red Sea level, right? So indeed, that's pretty low, and we've discussed in the slides before that the demand outlook is pretty depressed over there in the next few months. So we could see the market like not touching the lowest point yet, but it has to be seen. In Europe, we are not back at the pre-Red Sea level, but we are lower, of course, in the summer, but we could be at a low point already. So Golden Week is usually the lowest point of the year on the spot markets. We don't expect carriers to aim to close a long-term annual contract at the current spot market level. So some of them have already announced blank sailing, not only for Golden Week as usual, but already into November. So I think we can very confidently expect more blank sailings to come into November with successive rounds of rate increase as we get closer to Chinese New Year. And yes, I agree. So that's the theme of like the last fancy slide with the AI carrier image. I do believe that carriers will indeed work hard to push rates at a somehow higher level than today's spot market to negotiate their long-term deals. The last question we have. Oh, yeah, sorry, Sana.
Yeah. Oh, yeah. Well, I see another question coming in, but which one do you want to take?
I was going to talk about the break-even one.
Go ahead. I had another one coming in here. I'll take that one later.
Okay. Perfect. Now, there's like the other question we had is, and it's the $1 million question, if there's a break-even point for carriers on China, US, and China and North Europe, like below which they start losing money. So first, it's a secret well kept. Second, it's actually a very technical point, right? Because it depends a lot on the size of the vessel. Because the bigger the vessel, the lower the cost per unit. So that's why shipping line often look at P&L per voyage, per vessel voyage. So it's difficult to give one number that fits all vessels on a given trade. But what we can see is like if you go back in one of the last slide we have, and you'll have the slide deck, it's been shared already. You can see over the last few years the carrier EBIT levels, and you can see that in Q4 before the Red Sea happened, the average EBIT in the shipping industry, in the ocean freight industry for the carriers on the carrier side was negative, right? They were losing money. Well, on US, the price have already gone to those levels now, right? So imagine that the break-even point might already be passed and higher than the current market around those levels. And on Far East, we're not there yet on the price level, but we definitely close the gap a lot, right? So I think today's market price in October is definitely very close to this point. And that's why the answer from the question before was that we should expect carrier to take actions. All right,
Last
question.
Last question: how do we see the role of digital logistics intermediaries like ourselves in the current market dynamics and the future role? Well, let me be very clear. I don't think there is a future role for companies that are not digitally native. The world is much more complex. Your supply chains are getting more complex, and technology needs to play a role in this industry, right? You see it everywhere. Carriers are upgrading their technology. Forwarders are upgrading their technology, and we've come from a digital native place. And I think everyone ultimately that will be active in this industry will have a strong digital footprint to manage the complexity of this world, but also to lower the cost of operation. So I would say it's here to stay, and it's actually going to make the difference in the future how quickly you can develop yourself and adjust to the new world. All right. Thank you so much all for joining. Again, you can download the document here in the Docs tab. Thank you for your time today, and hope to see you again on our next webinar.